This week focuses on Chapter 10, which are payroll records. The first thing that I want to show you is what's called a W-4. And I'm sorry that the image is a little bit blurry, but you can see it in better detail in the e-text. But basically, when hiring new employees, employers need to verify the employee's eligibility to work in the U.S. They need the employee's social security number, their full name, address, their marital status, how many exemptions or allowances they're claiming, okay, and anything else. A payroll register is just a summary of employee information. So here again, we have the employee's name, their marital status, either married or single, okay, how many withholding allowances they have, so either 4, 2, 1, 5, or 1 in these cases. Okay. We also have how they're paid, whether it's weekly or hourly. We have the rate of pay, how many hours they worked, whether they had any overtime hours. And then we have their gross earnings, so their earnings before taxes. Okay. And then here we have deductions. So the first one is Social Security. The second is Medicare. We also have federal income tax, whether or not this person signed up for medical or dental, and any other deductions, maybe for retirement. Okay, finally, there is a column for their total deductions, which is just a total of all of these deductions here. And finally, their net pay or their net earnings is their gross earnings minus all of the deductions. And so for this example for Kyle, he has gross earnings of $756.50. After deducting $182.86, his take-home pay is $573.64. Okay, so calculating gross pay is relatively easy. You'll first multiply the number of hours they worked up to 40 hours and multiply it by their rate of pay. If they had any overtime, generally that is 1.5 times their regular rate. And so you simply multiply the number of hours of overtime that they worked by 1.5 for 1.5 times. Okay, and that's going to give you their overtime rate. Okay, and then finally, to get their gross pay, you would add their regular pay plus their overtime pay. And so if you recall from the payroll register, and I'm just going to go back a few slides, Kyle only worked 40 hours of regular time. So that was at a rate of $17 an hour. And I'll take out my calculator so you can see how it's calculated. So $17 an hour for 40 hours gives me $680. That's his regular pay. He made 3 hours of overtime at 1.5 times his regular rate. So I'm taking $17 and multiplying that by 1.5. That gives me $25.50. So that's going to be his overtime hourly rate. I'm multiplying that by the number of overtime hours that he worked, which was 3 hours. Okay, and then I'm adding $680. And that gave me the gross earnings of $756.50. So that's how he calculated his gross earnings. And so if you take a look at the payroll register, after the Social Security and Medicare section, there's a place for your federal income taxes. There's two main ways to calculate this. The most notable being the percentage method. Okay, so with the percentage method, you need to figure out what their payroll period is, whether they get paid on a weekly, bi-weekly, or semi-monthly or monthly basis. And there really is a difference between biweekly and semi-monthly. And so biweekly actually gets paid 26 times in a year, and semi-monthly only get paid 24 times in the year. So there really is a difference between biweekly and semi-monthly, although you might think that it's the same. And so when we're using this percentage method to calculate our federal income tax, after calculating the gross earnings, we have to figure out how many withholding allowances that person claimed. And so I'm going to use that same example with Kyle. So Kyle claimed 4 withholding allowances. And so assuming that he's paid weekly, what I need to do is to multiply the $76 for a weekly pay period and multiply that by 4. That's going to give me a total withholding allowance amount of $304. Okay, and so again, 76 times 4 withholding allowances gives me a total withholding allowance amount of $304. Now to calculate the amount subject to withholding, I need to subtract that from his gross earnings of $756.50. Okay, and that's going to give me an amount of $452.50. So this number here is the amount subject to withholding. And so obviously this $452.50 isn't our federal income tax up here, and there is a process that we have to follow to calculate that. Okay, and so for the first step, and this is using the percentage method, that's to first figure out the gross earnings, which we did. Okay, we also multiplied the appropriate either weekly or monthly one withholding allowance by the number of allowances. So recall that we multiplied $76 by 4 because that was the number of withholding allowances. The third step was to subtract that amount from the employee's gross earnings. Okay, and then now it says from the appropriate weekly, monthly, and single married percentage method table, subtract the excess over figure to get the amount subject to the tax. And so I know that sounds like a lot, but basically in figure 10-4 in your e-text, you have this image here, and it's separated into 4 sections. Table 1 is for people who are paid weekly. Then you have table 2 for people who are paid bi-weekly. Table 3 is for people paid semi-monthly, and then table 4 was monthly. Okay. Also in each table, it's separated by single or married. So if Kyle happened to be single, we would focus on this section here. If he got paid monthly and he was single, we would use this section here. But because he's paid weekly and he claimed to be married, payroll register, we're using this section. So if you recall, the amount subject to withholding that we calculated was $452.50. So $452 falls between $163 and $512. So now going directly across, the amount of income tax to withhold is going to be $0 plus 10% of anything over $163. Okay, after we calculate that, we then need to multiply that amount from step 4 by the appropriate percentage in the table, okay, which would be 10% in this case. Okay, and then if required, add the base tax amount. Okay, and that just means to add this amount. So you can see here, that if he had between $512 and $1,582, it would be $34.90 plus 15% of anything over $512. Okay, so I'm actually going to skip over so that we can see how this works. Okay, so we already calculated the total withholding allowance amount, the amount subject to withholding. Okay, and so for step 4, we're trying to calculate how much over, and let me pull this up, how much over $163 was taxable here. So we subtracted $163 from the amount subject to withholding. That gave us $289.50. Okay. And then also recall from the table that it says 10% of anything over $163. So we're multiplying by 10%, and this gives us $28.95 as the amount of tax withheld. Okay, and then for step 6, it said the wage range of $163 to $512 doesn't have a base tax amount and therefore doesn't apply in the case of Kyle Abram. And so that's where I mentioned, if he had actually made over $512 as was subject to withholding, then he would have had to pay $69.80 plus 15% of everything over this. Okay, so all we're doing is adding this number, which would be the wage base tax amount. So in this case, we don't have to because it was 0. And again, it's simply $28.95 for the federal income tax that was withheld. And so there's a second method to calculate the amount of tax to be withheld from an employee's pay, and this is called the wage bracket method. And it's a lot simpler, but it's not the exact same amount that you would get in the by doing the percent method. And so a separate table again is used. It really depends whether they're single or married, and make sure that you're aware of their payroll periods, as the text has different tables for different pay periods and different filing statuses, whether they're single or married. So for a married person and their gross pay, if you recall, Kyle's gross pay was between, I think it was around $752. So it fell between $750 and $760. Recall that he also had 4 allowances. So this tells me that the amount of income tax to be withheld, if he's using the wage bracket method, okay, so $29 with the wage bracket method, which was really close but not exact to the percent method, in which the amount of tax withheld was $28.95. Okay, and so the percentage method is a lot more accurate than the wage bracket method. Okay, but still they're pretty similar. Okay, other things that you'll be calculating are Social Security taxes, Medicare, and maybe even other withholdings. Okay, so FICA just stands for the Federal Insurance Contributions Act, and this includes Social Security and Medicare. So the Social Security tax is 6.2% on the gross pay, and the Medicare tax is 1.45% on gross pay. Okay, and so it's actually distributed among both the employer who pays some of it, and then it also gets taken out of our personal paychecks as well. And so in this example slide, we have how Social Security is calculated. And so if you recall, Kyle's gross earnings was $756.50. Multiplying that by 6.2% for the Social Security, that tells me that $46.90 is going to be deducted from his paycheck for Social Security. And then for Medicare, we're taking his gross earnings and multiplying that by 1.45%. And so $10.97 is going to be deducted from his paycheck for Medicare as well. Okay, and so if it asks for your FICA amount, that's simply your Social Security plus your Medicare amount. And so in this case, I have $57.87 in total FICA. So that's just my Social Security plus my Medicare deductions. Some other deductions include things like medical or dental or even vision. And these premiums really depend on the plans that your employer offers and the plans that the employee chooses from the available ones. Okay, and so employers also have to take into account how much wages that they have paid their employees, either monthly, quarterly, and yearly. And also this is important for W-2s that employees need to do their own taxes, which shows their cumulative wages, also Social Security for the entire year, Medicare, all of the federal income tax that they paid, and so forth. And then finally, we have computing an employer's federal and state unemployment tax liability. So contrary to what a lot of people think, it's not just the government that pays for unemployment. A lot of this money comes from employers themselves. Okay? And there are steps in calculating how much employers have to pay in these FUTA. So FUTA just stands for Federal Unemployment Tax. Okay? And so basically, they need to pay 6.2% on the first $7,000 that's paid to each employee. For the state unemployment tax, they're required to pay 5.4% on the first $7,000 paid to each employee as well. Okay, and then there are some examples of how to calculate everything in this week's practice problem example video.